Talk macros, and to do that, let's connect with Professor Shankar Acharya, former Chief Economic Advisor with Ministry of Finance and Honorary Professor with ICRIER. He joins us from New Delhi. Professor Shankar Acharya, good morning. Thank you for joining us. Many estimates on growth. Some even say, for this current fiscal, we could get a print of sub 5%. What is your assumption? What do you think will be the GDP growth number for FY13?
At this stage, with 3 quarters almost done and with numbers on 2 quarters available to us, a reasonable guess is around 5.5% or thereabouts. Maybe a shade lower, maybe a shade higher, but I don't think it'll get to sub 5%. One can't completely rule it out, but I don't think it will. I think the more, for me, the larger concern on growth is really that I don't see a sharp pickup in the coming year, that is 2013-14, because all the things that are at work in slowing down our growth over the last 2 years, I think are still very much in play. So perhaps I'll be sticking my neck out, but I think growth next year is also going to be probably sub 6%, perhaps 5.5 to 6%.
Right, Professor Acharya, the strong IIP numbers have made some people, especially at North Block, believe that the economy is beginning to bottom out and green shoots are visible. Do you agree with that assessment?
I would first caution you that back in February when the budget was presented, or was it March, North Block was talking about 7.5% growth this year. And that's not such a long time ago, and we now know that was way too optimistic. Now going back to the more recent IIP numbers and so on, I think a lot of commentators have already pointed out that the IIP data for the month that we've seen, that is October, which showed this 8% rise, has to be, in a sense, caveated by the fact that previous October there had been a minus 5% or so, and so that really it's not quite as resounding a jump as it looks like, and it's all to do with which month Diwali falls in and all that sort of thing. So I think the idea that it has bottomed out, possibly, I don't have a strong view that whether it has bottomed out or not. What I would say though is we might be if it has bottomed out, that we may remain at a rather low plateau for quite a while.
Professor, be candid. Do you think banking, insurance and pension bills will see light of the day in this winter session of the Parliament?
Well, the banking bill, I'm surprised that the banking bill hasn't gone through. It was a relatively controversial bill, except I think the government made perhaps one small but cardinal error in introducing this, I believe, new clause to do with banks being allowed to participate in commodity-related derivative trade. And that, as far as I know, was against the advice of the central bank, the RBI, and I don't know what the urgency of that was, but that seems to have really upset the opposition, in particular, of course, Chairman of the Standing Committee, Mr. Sinha, who felt that the whole thing has to go back to Standing Committee, and that seems to have kind of gummed up the process on what was otherwise a relatively non-controversial bill. Whether it will get through, well, we don't have that many days left. Next week, really. And remember that on the day of Friday is taken up by private members' legislation. So we only have some 4 working days, and who knows what halla will occur for whatever reason in between. One can't predict. So even what is a relatively controversial thing, and remember all these things go through 2 houses, I wish I knew. But at this point, it's not looking a done deal. And when it comes to the other ones, insurance and pension, I think one has to say that those chances of those getting through this session of Parliament are declining by the day.
Inflation continues to be sticky though, especially food and fuel. Is it fair to presume the chances of any rate cut are further diminished and there are no chances of a change of heart at the RBI?
Well, look, I'm not in really, I shouldn't comment on this point because I'm a member of the advisory committee to the RBI on monetary policy for the last 7 or 8 years. And so I wouldn't comment on the specifics. I think, putting it differently, you know, I think crafting monetary policy in the last few years has been especially challenging because it's been done against a background, as we all know, of a slowing economy, rapidly slowing economy on the one hand, and persistent inflationary pressure from different sources, you might argue, cost push, demand pull, and so on and so forth, but clearly strong inflationary pressures. And so it has always been somehow a matter of striking a balance. And the third factor which has complicated all this, of course, is that throughout these last 3 or 4 years, we've had a huge fiscal deficit, center and states combined, and that continues to the day, which makes it, you know, very difficult, I think, for a policy of monetary restraint.
But Professor, while we are talking about revenues and disinvestment, the NMDC FPO has got a resounding success. Do you think there is enough and more appetite for good quality government paper?
Well, from what little I read on these sets of issues, it doesn't look like the market for any kind of paper, whether IPOs or government paper, is all that strong. But as you pointed out, the NMDC one did do reasonably well. So we should wish the government luck that they get close to meeting their target. I don't think I have anything useful to say further than that on that point.
Right. India has also seen, strong fund flows. Will it continue, and what will be its impact then on the currency?
Well, don't forget our trade and current account deficits are still very large, and in fact are getting larger, not just in absolute terms, but in ratio to GDP and so forth. So our reliance on external fund flows is growing. And so it's a good thing that we are getting these FII money and any other kind of money. But at the same time, I don't think this is a durable, sustainable state of affairs, because the nature of these flows, as we know, is that, they come and go. That is when, all this business of risk on versus risk off, what's happening to markets, capital markets in the developed world and so forth, all those considerations come into play. And so, if you look at the annual figures of, say, FII flows, they bounce around a lot. And it would be, I think, a mistake to think that one can always rely on these flows to be buoyant, which is why I've always felt that, certainly at this time, our focus should be on bringing down our trade and current account deficits. And that really gets us back to issues of competitiveness and sound economic policy in a much broader way. Without that, I think we're in for greater external vulnerability in the near term.
Right, Professor Shankar Acharya, really appreciate your time and thank you for your robust and wonderful insights.